you water. I hope you enjoy your food. It's from the Jack and Us. I know that's some kind of fancy menu, mushroom stuff, some kind of fancy stuff. And it looks like I'm not going to be able to try it, but anyways. I don't know, I'd rather you have the chance to try it. So let me introduce our speaker to you. Dr. Matt Ryan. He received his PhD from West Virginia University. And since then he was teaching at Duquesne. Yeah, I wasn't sure how to pronounce it.
How do you pronounce it?
Duquesne University. Despite the French looking name of university, actually it's located in Pittsburgh, Pennsylvania. And Professor Matt Ryan, he has outstanding research and teaching record. His publications include top economic journals such as Public Choice, Economic Inquiry, Journal of Sports Economics, and Applied Economics. So it's our great pleasure to have Matt Ryan today speaking to the Econ Club. And please join me in welcoming Professor Matt Ryan.
Well, thank you, Leo, certainly for the introduction, and thank you guys for inviting me down here. I was actually down here last weekend for a wedding. It was decidedly warmer. I was getting away from Pittsburgh to hopefully something warmer, but the weather was kind of the same this morning as it was down here, so maybe I picked, I guess half the time maybe it's decent weather, half the time it's a little bit cooler. But let me actually just ask a question before I get started here. How many people have bet on something before? Formally and informally? Good. I think we're going to have a good time this afternoon. People ask, now I like doing research on wagering markets. There aren't a lot of economists out there that do research on wagering markets, and so there's kind of like two charges that I like to have to start with regard to wagering markets to kind of set the table for why I feel looking at it. Number one, a lot of people think, and your show of hands shows otherwise, but a lot of people seem to think that wagering is something that's on the fringes of society, or it's something that only applies to a very small slice of individuals. That's not true. Okay, that's absolutely not true. More people wager in this country than don't. Right? Wagering is something that's worth looking at. This is not a 2% activity. This is not a 5% activity. This is more individuals wager. Okay? More individuals have wagered in this country than haven't. And on top of that, it's rooted in history. Not only history of this country, but history of the world. Get this. All right? Dice. Okay? Probably the oldest form of wagering out there. Dice. This sentence blows my mind every time I say it. Dice are older than numbers. Think about that for a second. Dice are older than numbers by like over 1,000 years. Okay, the oldest dice they've found predate written numbers by over 1,000 years. Okay, wagering is something that's in the fabric of human nature. Okay, it's in the fabric here in the United States as well. Okay, plenty of cities have had lotteries to try and establish funds for setting up the building of the city. Washington D.C. is probably the most well known of that. Actually, trivia question: do you guys know who bought for Washington D.C. the lottery to fund Washington D.C. the building of Washington D.C. Does anyone know who bought the first lottery ticket before that? George Washington actually did, right? George Washington bought the first lottery ticket to help fund Washington, D.C. George Washington actually kept really very, very extensive records of how much he wagered. On average, he'd go out and wager significant amounts of money about every other week. Okay? This is rooted here in this culture of America. It's rooted in the society of histories of individuals. Yale and Columbia University had lotteries early in their histories to help establish their endowments. Where I'm from, Pennsylvania, you could make the argument that Pennsylvania existed as a result of wagering. The argument goes like this. So Charles II was the one that awarded the Pennsylvania colony to William Penn. William Penn's father and Charles II were actually very, very close. Okay? On William Penn's senior, I'll say William Penn Sr. on his deathbed, he actually looked to Charles II and said, "Will you take care of my son for me?" They were very, very close. Right? Turns out Charles II was an extensive wagerer, an extensive gambler. Okay? And had extensive debts that he owed. Okay? To William Penn Sr. Right? Because if we look back at history, we see Quakers not particularly well liked in England. Why give them a colony? It doesn't really make a lot of sense. One argument they say is perhaps that colony was given as a settlement for wagering debts between William Penn Sr. and Charles II. If you want to go even one step further, think of Philadelphia. People like to talk about the cradle of American liberty. You could say that American liberty was a result of gambling, if you want to even take that step so far. Gambling matters quite a bit. One more example, one more story before we get going here. I think this is the best one. So, guys remember the 2000 election? Al Gore, George Bush, maybe not personally remember, but heard of it, certainly big deal, Supreme Court, whole deal. All right, do you guys remember the state that was kind of at the middle of it? Florida, right? Absolutely, it was Florida. So we've got the hanging chads, and we're recounting votes, and this whole deal. This rigmarole back and forth, kind of lost to history. There was actually a very, very close outcome in New Mexico as well. In fact, they recounted the votes 3 or 4 times, and the winner actually swapped back and forth. You realize New Mexico's not that big a state. But nonetheless, they recount the votes, Gore's ahead. Recount the votes, Bush's ahead. Recount the votes, Gore's ahead. Very, very close. Not making this up. In the New Mexico Constitution, okay, in 2000, had they ended up tied, all right, for, we count up the votes, they end up tied in the state, they would have broken the tie, written in the Constitution, by a mutually agreed upon game of chance. It's written in the Constitution. How great would that have been, right? Mind you, okay, I think it's 3 electoral college votes there. Right? Obviously it's swamped out. But imagine everything broke perfectly. And somehow we had a tie in New Mexico. How great would it be? Right? The World Series of Poker just finished last week. How great would it be to have Bush and Gore sit down for the presidency heads up? How awesome would that be? That would be pretty amazing. So gambling there's a lot of it. There's a lot to gambling, there's a lot to wagering, and these are important things to be looking at. Second, okay, more down the economics path. When it comes to looking at the process of price discovery, when it comes to looking at the process of price determination, when it comes to the process of achieving equilibrium, empirically, okay, I will argue heavily that there may be no better place to be looking at than wagering markets, to be understanding empirically, with numbers, with statistics, these phenomena of how we're moving around. Okay? If we walk out there, this concept of efficiency, this concept of how we get to equilibrium, right? If I ask you a question, let's say you go down to Bourbon Street, right? Is the market for hurricanes the drink? Is the market for hurricanes in equilibrium? That's a hard question to answer, right? That's a hard question to test. There's a lot going on. You have the supply side, you have the demand side. It's a difficult question. That's tough. You can make some headway, but that's really, really hard to answer. Okay? Even on top of that, when people like to think of the cleanest areas to try and test efficiency, a lot of people like to look at financial markets, like security markets, stocks, things like that. Wagers actually have a lot of nice characteristics on top of stocks that make them even cleaner to study. Primarily, I'm not going to go too far down that path, but primarily, stocks are kind of infinitely viewed. There's no ending point to a stock. Okay? Numbers-wise, that makes things kind of difficult to deal with, right? But wagers, they're really nice. Okay? You know the duration of it. It's got a very clear value at a certain point in time, given a certain event. Okay? Those characteristics are nice. Okay? And it allows us to look into these concepts of efficiency, of price determination, of price discovery. We can really make a little bit of headway there. So, along the lines of dealing with efficiency, the way that we want to be talking about efficiency is with these 2 definitions. We talk about subjective probability, and we talk about objective probability. That's the Greek letter rho for subjective probability. Objective probability is going to be high. Subjective probability is going to be basically the market-determined probability of an event happening. Okay, so for example, let's say, and we're going to get to particular examples here in a second, but let's say we look at a baseball wagering market. All right, we go up to the big board and we see a couple numbers there for a baseball wagering market. We can infer what the subjective probability of either side winning that game is going to be. Okay, we go to a horse race, we see the big board, we go all the different horses there, we go to the dog track or horse track. Right, you see all the different numbers up there. We can infer what the odds of that individual horse or that individual entrant is going to be. All right, that's the subjective probability. That's the market-determined probability of that happening. The objective probability is the after the fact, the ex post chance or the probability of how frequently that event does occur. So let's say every time we see a baseball team that has a 40% chance of winning the game, let's say that's what the market determines the probability to be. Okay, we can actually look and say, well, every time there's a baseball team that has a 40% chance to win, how often does that team actually win? Is it 45%? Is it 35%? Is it 20%? And that's kind of the comparison we're making here. So we've got subjective probability and objective probability. If we want to graph it, sometimes it's easier for a visual person to kind of view what's going on here. We've got subjective, objective. If we have perfect efficiency in this market, we should be right on this 45-degree line, right? If there's a 5% chance, the market says there's a 5% chance of a team winning, then the objective probability is 5%. We're efficient, and that's kind of the line that delineates efficiency for us, right? Efficiency in the market. The market's doing a good job of determining these probabilities very, very effectively. Okay? So statistically, if we want to test that, our null hypothesis, the efficiency is when the subjective probability is equal to the objective probability. Rho is equal to pi. So if we do our statistical test, we reject the null, we end up with inefficiency. When we reject that hypothesis, the statistical probability is different statistically than the objective probability. All right, so that's kind of the first step. That's efficiency and inefficiency. Next step, when there's a pattern to the inefficiency, that's what we call bias. Okay, so we can, if we look at this, we can have kind of a blip on the radar, or a blip on the radar, or a blip on the radar. There's different kind of points of inefficiency that we see around here. When there's starting to be patterns to those inefficiencies on this graph, that's what we call bias. Bias is what we're interested in getting at here. Okay, patterns to the inefficiencies that we see in these markets. And again, I'm not sure how familiar some of you guys are with regards to wagering markets, but there's kind of two very, very common biases that people like to get after with regards to just the types of disturbances we tend to see in wagering markets. By far the most common one, been studied for decades, generally in horse racing, pari-mutuel markets. We'll get to that here in a second. It's called the favored long shot bias. Just cutting to the chase real quick, I don't have a whole lot of time today. Basically, in that situation, we see this persistent bias where if you go down to the racetrack in a lot of situations and you bet on favorites, you're probably going to make more money than you bet on long shots. There's a lot of discussion as to why that might be the case. Okay, there's a lot of discussion as to why that seems to persist. Okay, but that's the most common one. Favorite long shot bias. Any sort of wagering market research that you do, to be honest, anything published anywhere is probably somehow, some way, going to have to tie itself back to that concept of the favorite long shot bias. That's something that kind of, even people that are only partially aware of what's going on in wagering markets, that's something they can kind of anchor to. So that's where kind of research goes from that. And as economists can be staggeringly creative, they have the reverse favorite long shot bias as well. That's just the opposite. For example, in most European and North American markets, for betting on dog racing or betting on horse racing, they tend to have a favorite long shot bias for reasons that people can't really seem to understand. In like Australian and Hong Kong markets, it seems to be a reverse favorite long shot bias. It's kind of this question that's kind of looming over there. Why do we persistently see different bias in different markets? But bias is the issue that we're looking at here. We want to be looking for bias, and that's a function of just like groupings of inefficiency when we move forward. So moving forward, it's going to help for this particular analysis that we're doing today to group these wagers into two different types of wagers. The first type of wagers we're going to talk about constant return wagers. These are probably wagers that you're pretty familiar with. For example, I know the Bengals are playing against your very beloved Saints this weekend. I checked out the point spread yesterday. It's 7 points, so this point spread wager, you basically can decide to wager on either the Cincinnati Bengals or the New Orleans Saints. You end up with a final score. You add 7 points to Cincinnati's score, and whoever ends up ahead after that adjustment ends up taking that bet. If you bet on Cincinnati, and let's say they only lose by 3, they would win that bet. If they win the game outright, they win that bet. If the Saints win the game by more than 7, then the Saints will win that bet. If it's exactly 7, the bet's off, and you get your money back. We also have over-under wagers. The over-under for the Cincinnati-New Orleans game this weekend is 50.5. So all that is you just take the points that the Bengals score, take the points that the Saints score, and you add them together, and you bet either whether you think it's going to be above that total or below. If it's above 50.5, you win if you bet the over. If it's below 50.5, you win if you bet the under. The important thing about these bets, this is really, really important, is either side of these markets earn equal returns. Okay? For example, if you bet on Cincinnati and win, you get the exact same return as if you bet on New Orleans and win for that point spread wager. Or if you bet the over for this game and win, you get the exact same return as if you bet the under in this market and win. That's really important. For example, like if you go to Vegas and do this, usually you put down, for every $20 you put down, you return 38, so you get $18 on your original $20 bet. In that situation, that's a very typical return. The casino here is trying to get equal money on both sides. Like imagine a situation where, let's say I'm in the house and I take bets from both of you guys. My goal is to get you to bet on Cincinnati and you to bet on New Orleans, right? Because at worst, New Orleans wins by 7, you get your money back. If not, I'm paying one of you $38, but you together paid me 40, so that's a risk-free profit for me. So that's kind of the goal of what's going on. Yeah?
I think the spread 7.5 or 6.5, that way there'd be no bet.
There would be no tie there, but as particular football, and actually, I mean, I happen to pick the regular example for that exact question. 7's a big number in football. When we talk about basketball point spreads, and I should have said before I start, if you guys have questions, shoot your hand up, by the way, when we're talking. No, I have to wait till the thing. If we look at basketball, there's a whole lot of scoring in small increments. So there's like 30, 40 baskets a game, so we see a lot of scoring. Football, there could only be a handful of instances where they actually score. The difference between 7 and 7.5 could be big. Maybe they wouldn't want to have a position of 7.5 and expose themselves to risk on a 7-point game. Maybe there's a lot of chances where New Orleans, their model is showing New Orleans beating Cincinnati exactly by 7. 7.5 would cost a lot of money. They might get a flood on one side. Right? Or it also could be, I didn't see what the opening line was. It very well could have been the case that it opened at 7.5. Money maybe came in such that the line adjusted to 7. That could be the case too. But no, I mean, you're right. And the interesting thing too is, I haven't really even considered this before, but just thinking about now, you are far more likely to see half points here on the over than up here. These are bet a lot more often too. Yeah?
How much do they usually cost to buy a half point or a point?
So what we're talking about here is just like you're going into the sports book and you're just placing basically a straight point spread bet or over under bet on what's going on. You're talking about a situation where you can buy points around. That turns it actually into a variable return bet, which is an amazing question because that's what we're going to talk about in the end. Actually ends up being kind of like a money line wager in that situation. Good question. Any other questions while we're here? Good point to ask questions here, because otherwise if there's confusion, the rest that we're talking about can be kind of confusing. Yeah?
In the point spread, the 7-point wager there,
Sure.
Is it that if it's exactly 7, that's the house takes it all?
No,
like
that's
betting on
the house
green?
takes nothing. Everyone gets their bets back in that situation, right? There's occasional situations where, usually we see articles about this for really big games. So let's say like the national championship game of basketball ends up being a push, or the Super Bowl ends up being a push, right? The casino does everything they can to balance that money on both sides, right? Because it doesn't have to be perfectly balanced. You can run the numbers. It doesn't have to be perfect. It has to be kind of close. What they want is to have even money. They don't want to be sitting there absorbing risk on the outcome of sporting events. They want to be sitting there and being like, all right, play it off and let's just get some money for it, right? But I mean, Walter's points is a variable, okay? But it could, even a half point, could even, tip the scales in terms of risk. Not that they won't know. I mean, I would say second on their list of things is trying to make certain they get, a commission off this or a vigor issue, what it's called. They want to get that money. But I think first on the list is avoid being, susceptible to the risk of the outcome of the game. Good question. Any others for order? Okay, so let's talk about variable return wagers as well. So the research that I'm doing, that I'm going to talk about today, it's a big function of a variable return wager as opposed to a constant return wager. So these different kind of wagers we can look at. There are types of wagers, we call them pari-mutuel wagers. These are pools that are like horse racing pools or dog racing pools. There are other kind of lower pools that resemble this as well. The characteristic of a pari-mutuel wagering pool is that there is no central odds maker. If we look over here, we've got a sports book setting these lines, attempting to find perhaps the middle of the market, attempting to find the balance between the two sides of the market, getting money on equal sides. A pari-mutuel return is a function simply of the money put into the market. Okay, so here's what happens. Let's say, and there's a lot of people who think, let's say we see a big horse race on TV, the Kentucky Derby, let's say, right? We know before post time, we've got all these different odds for horses. Those aren't the payouts for the bets. Okay, that's actually what an individual thinks that the odds eventually are going to be. Right? What happens is, let's just take the simplest possibility here. Let's talk about the win market. A win bet on a horse or a dog is saying, I think that entrant is going to win the race. Okay, period. That's all they can do is win the race. Right? Let's say we've got 10 different entrants. There's going to be different amounts of money on those different entrants in the race. All right? Those entrants that end up having the most money bet on them become the favorites by virtue of the fact that the most people have bet on them, and then their payouts are a function of the money that's bet on them as a percentage of the whole pool after the track takes its take out of there. Actually, when it comes to pari-mutuel wagering and why it's so widespread, and why casinos love this and off-track betting individuals love this, this is risk-free profit, okay, for the track. All right, and it's huge. You want to take a guess? So let me just throw it out there. It can change, but broadly speaking, You've got a track. They take all these bets in. They collect them all. They take their slice and then pay out the rest. So you want to guess what their slice is? It's not a bad business when you get into it. 20%. It's a big slice. Okay? Risk-free in that situation, so they divvy it up win style. A place bet is betting that your individual entrant will finish either first or second, doesn't matter which. A show would be first, second, or third, doesn't matter which. You could have these fancy bets on top of that as well. You could have exactas. That's picking the first and second place finishers in the exact order. A trifecta is the 3 top finishers in the exact order. Superfectas, 4 crazy combinations of them and all this. Those are very neutral bets. The important thing is a bet on one entrant is not necessarily going to pay the same return as a bet on another entrant. Okay? We can also talk about money line wagers. These are going to be most common in baseball, next most common in hockey if we're talking major sports. There are money line pools for all 4 major sports, but baseball is the one that leads the way here with regards to money line wagers. If you walk into a sports book, you see something like this. You have Oakland at negative 160, Kansas City at plus 145. This would make Oakland the favorite. The favorite's always the one with the negative number on it, or you could have a situation where they could both be negative. It's the one that's going to be more negative in that situation. Anyone with a plus is going to be an underdog, and the way that we determine these payouts is as follows. If I'm going to bet on Kansas City, they're the underdog. For every 100 units that I bet, you don't have to bet 100 units, but for every 100 units you bet, you get paid out 145 units, okay, or 1.45 to 1 there as well. If you bet on Oakland, you need to bet 160 units to pay out 100 units. Okay, that's just how the ratios work for that. So Oakland, in that particular circumstance, you get paid 62 cents, 62.5 cents on every dollar that you bet. Kansas City, you get paid $1.45. So we realize now, right, it's not just a simple point spread trying to figure out a win-loss. It's really a very particular way of adjusting subjective probabilities to try and really figure that exact chance of winning. Right? It's much more granular, right? You get a lot more detail in that situation. So, looking at my particular research here, I want to look at Major League Baseball, and I want to look at a couple of things. First, basically, kind of the statistical question I wanted to ask. Does bias exist in the Major League Baseball wagering market? Let me be clear. This is kind of one thing we can talk about with regards to wagering markets being such a symbol and such a beacon of spontaneous order, such a beacon of price discovery, such a beacon of arbitrage, and just the market process as pure as it can get. All of these, I mean, I've done survey papers on wagering markets. The staggering majority of the existing research out there on wagering markets finds them to be amazingly efficient. Okay? And the really remarkable thing about that is not so much the baseball markets and not so much the professional sports, like the 4 major sports in the United States market, soccer, it's not that. It's really the horse racing stuff that's amazing, because you can go and you can bet legally, off-track betting. You can bet and go to a local area and go and bet on any horse race in the world, right? Your bet goes into the pool. Okay? Think about that. Okay? These markets are staggeringly efficient. Okay? And whatever that means in your mind, in terms of whatever that means, let me just say it this way. There are no strong, persistent profit opportunities here. Not even small ones. I mean, we're talking very small. And those don't even tend to persist. They tend to be fleeting. Okay? Think about that. You've got thousands of people spread around the world betting on a race continents away. They can all get together with their separate information through this wagering system, can generate a subjective probability in the long run that basically matches the exact probability of that horse winning. That is amazing. That is amazing. That is markets in action. Okay? Wagering markets are remarkable. So the challenge here, can we find any bias in this Major League Baseball wagering market? And second, if we can find some bias, do we have any economic explanations that help kind of explain why we see this persistent inefficiency? First question is just being a statistician, okay? Finding the numbers, running them, seeing if we can assess whether there's a bias or not. That's just running numbers, okay? The second one's where you get to be an economist, all right? The second one's where you get to go in there, use your economic rationale, figure out why we see this bias, figure out why it ends up persisting. Okay, quick cut to the conclusion. We do have bias in the Major League Baseball wagering. Okay? Can we explain why it's there? That's the big question we want to get at. So, in the broadest sense, there were a few papers ahead of me that were looking at money line wagering in the Major League Baseball wagering market. They found it staggeringly efficient. And to the most part, I found the same thing. All right, if we want to talk about two different types of efficiency in, before we get to types of efficiency in wagering markets, in financial markets. Have you guys heard like strong form and weak form efficiency in the stock market? That's kind of ringing the bell, right? Kind of the weak form being, you can't use fundamentals to earn excess profits, and the strong form goes all the way to like insider information, right? They have these similar kind of equivalent concepts in wagering markets as well. A market's going to be weak form efficient if there's no persistently profitable wagers, or I probably should say it better than that, no persistently profitable wagering strategies. Maybe that's a better way to say it, right? Because if we were thinking of kind of ways to get ourselves into these markets and try to have persistent profitable strategies. If it's strong form efficient, we describe that as wagers do not differ statistically from the wager's expected value. Mind you, if we have any wager, because there's going to be a commission taken by the book, right, I kind of talked to you about that 20% that the track takes with regards to 20% the track takes with regards to pari-mutuel wagering. By virtue of that spread, let me go back a little bit, the way that sports books get their commission by having a spread between these two numbers here, so there are commissions in every bet. So by virtue of the fact that there's commissions in every bet, right, we basically are going to have a negative expected value on every bet. Makes sense, right? Every bet I'm going to have, as you're going to see the numbers come up here, every bet's going to have like a negative 1.8%. Had a big difference by the different way we slice it, but maybe negative 2%. Okay, every dollar that I bet over the long run, I can expect to lose 2 cents to the book. That's kind of how the numbers ended up playing out in this situation. And I'm sorry, is that big enough for you guys to read? It's so hard to tell when you're working your laptop. I bet the presentation is super huge, massive. Can you guys read that? A little bit. So if we look at May through September, all right, my data set goes from 1999 to 2009, all right, and we look at every single bet that could be placed on a Major League Baseball game, both sides. So it's like 25,000 games, something like that. All right, that was actually more than that, but maybe closer to 30,000 games. We make every single wager possible, right? That's how the statistical analysis works. We've got on either side and run it through and see what the wagers would have been. And you know what? If I bet on nothing but underdogs, okay, here from 1999 to 2009, all underdogs, May through September, I would have earned, this isn't like hypothetically, this is what I actually would have earned, okay? Betting on every single underdog in every single game, I would have lost about 1.8%. My expected value was about 1.73, so a little bit worse than expected, actually. Okay, you could actually infer from this as well. If you bet on nothing but favorites, you'd actually be 0.7 on the other side of that, so you'd be about minus 1.6, let's say, if you bet on nothing but favorites. Okay, that is the hallmarks of the staggeringly efficient market, by the way. Okay, no one side is persistently strong. All right, you're right near that expected value. That market is doing a really good job of figuring out exactly what's going on. We also have, and it's going to make more sense, we'll look at these following slides, heavy underdogs. Okay, so if we look at heavy underdogs, if you go back to what we had before, you remember that Kansas City was plus 145, that's what we said there, the underdog. We define a heavy underdog, the literature has just defined it as any underdog that's going to be plus 160 or greater than that. That's just what's defined as a heavy underdog. So if we bet only on the heavy underdogs, we would have 4,600 instances of being able to do that. We would have been about 1.4% up, actually. But by virtue of the numbers and the z-statistics, we can't say we're statistically different, okay, from that zero value, from that expected value. There's just not enough there to make a conclusion that that's profitable, even at only 1%. There's just not enough there to say that that's something different than chance, right? However, you guys notice, if you're a baseball fan, like I am, all right, that was May through September. When this baseball season starts in April, right? So we have betting in April as well. In fact, there's a lot of bias in this market in April. All right, underdog wagers during the first month of the season are going to be persistently profitable. Here's the wager we want to look at here. There should be some numbers that jump out at you here. This isn't a simulation, all right? This isn't a model that's predicting this is going to happen. This is if you did this from 1999 to 2009. Okay, this is what would have happened. We have all the lines, have all of them. Okay. If in April, the entire month of April, you bet every single underdog, just across the board, I don't care who it is. Every single underdog in the month of April, 1999, 2009, we've been up about 3%. Okay, and when we come over here to the statistics, right? Z1 is going to be the difference, I don't know if you read this down here, the difference from the expected value. We can tell then, at this point, that we've got a good degree of separation from that expected value. And in terms of it being profitable, okay, that's the 10% level of statistical significance. It's not super strong, but we're starting to see numbers that are bigger than we saw before in April. Something's going on in April. If we bet on, nothing but heavy underdogs in this situation, you see we're about -1%, and of course that's very, very close to the expected value. Nothing's really coming out here. However, let's scoot it up to early April, okay? April's the first month of the season. Let's take the first half of April, okay? First 2 weeks of the season, April 1st are any games that happened before April 1st up to April 15th. That's all we did. And make all of those wagers, okay? This isn't like some sophisticated betting strategy either. This isn't like, well, when a left-hander's pitching and it's 60 degrees and the grass doesn't look that good and there's only 5 people in the stands, we're going to bet on the home team, right? It's nothing like that, right? This is just saying every game, pick an underdog in April. That's it. Simple betting strategy, okay? If we bet on all underdogs, things jump up. We were at 3%, now we're up to 7%. Okay? These are starting to be pretty big deviations in staggeringly efficient markets, by the way. Okay? Over that span, a 7% deviation. Statistically very strong, of course. The big one here, this is the huge result. This is the result that you published. Okay? This is the big result. Heavy underdogs in early April. Okay? God, you would be surprised how many probably somewhat seedy individuals were shooting emails after this came out. Okay? Because I'm just saying, look, if you bet on nothing but heavy underdogs in the first 2 weeks of April, if you've done that over the last 11 years, you'd make 28% of your money. 28%. Okay? And it comes with all the financial caveats, you know, like you go to investor and past performance doesn't include future results, you know, things like that. Right? That's the numbers though. Like there's nothing, that's it. I mean, I saw that and I was like, oh, that can't be. So you run it again and you're like, and then you like go back to the data like from how you pulled it from the site and then like rerun the whole, right? Like you want to make sure, because this is huge, right? This is a big result. Okay, this is a big deal to find something like this. 28%. Mind you, let's be clear, if we go back, we're talking 21,000 bets here. Okay, that's a lot of bets. 4,000. Realize the numbers are getting a lot smaller. Okay, because we're only talking April, and now we're even splitting up the people in April betting on. Nevertheless, okay, it's there. And I love it when people, when they see these results, they like to say, well, it's only 146. That's a small sample. You know, you don't really know what's going on. Okay, I mean, it is a small sample, but like this. We have like z-scores. Doesn't like the sample size go into the z-score? Like, can't we actually like calculate that in there and see if it's different? Look, it's 99%. Look at all those stars. Fold. Right? It's different. It is, right? It's 28%. Again, you're not saying this before, but you're saying, look, that's 28%. So something's going on here. So we've got this bias. That's just the statistics of it. What explanations can we have? And so I sat here and, you know, people will publish papers just with that. That's not being an economist, though. It's not fun. Okay? The fun part is trying to figure out what's going on. Right? Are there explanations? I think there are. Right? I think it has 3 parts. So to start with, information. This is all about information. The paper's called Information Effects in Major League Baseball betting markets. It's all about information. All right? To start with, information is low on baseball teams early in the year. What do I mean by that? We have a hard time in baseball, especially compared to other sports, in being able to tell when the year starts what teams are going to be the really good teams. We have a hard time with that. Just put a few teams up there. For example, this year, Kansas City made the World Series. Okay, that was actually the first time they made the playoffs since like the 80s. Okay, I think it was 29 years. It was the first time they made the playoffs in 29 years, much less made the World Series. They made the World Series then too. Okay? Had you said in April, you probably could have got pretty good odds at a sports book betting Kansas City to win the American League and go to the World Series. Okay? Not a lot of people out there thinking that's the team that's going to go. A lot of people thought Boston, to be honest with you. They won the World Series the year before. Okay? They were the worst team in the American League. Okay? Information's low on the good and bad teams early in the year. I'm from Pittsburgh. Pittsburgh had a hell of a year in 2013. And Tampa Bay in 2008. Not only had they never made the playoffs, their entire franchise history had never had a winning record ever. And they made the World Series that year. There's a lot of uncertainty early in the year. That's an important part, okay? Because early in the year is when you're making the bets, okay? So there's a lot of uncertainty there to start with early in the year. Second, information updating in Major League Baseball is slow. So I played baseball growing up, I coached baseball. This is kind of where the non-economist, but the actuality of the game kind of comes in. You know, it's amazing to look at, football records and basketball records and even hockey records. If you look, I live in like one of the two cities in this country that like cares about hockey, so I hear about it all the time. But if you look at the best, like what's the best team in the world now? These Arizona Cardinals are like 8-1, I think. So that's 88% win percentage, right? And if you look at the worst team, I think is the Raiders, and they haven't won a game. So that's like a big spread, right? 88% is 0. All right? And if you look at the end of the year, the best teams in football, you probably have a team that wins like 13 games every year. That just kind of happens. I don't know. You always have a team somehow that wins 13 games. You always have a team that wins like 2 or 3. It always happens. That's a big spread winning percentage. Okay? And in the NBA, it's the same way. Maybe not quite to that degree, but the best teams win, maybe in the 60s, and that's a lot of wins, right? That's like 75% of your games, and the worst teams win like 20 or 25%. It's a big spread. Baseball's not like that. Okay? Baseball's not like that. Look at the standings at the end of the year. Broadly speaking, in the roughest sense, the best teams in baseball generally win about 60% of their games. They do. Their winning percentage is .600. Okay? It's about 60%. And the worst teams are about 40%. Okay? So if you want to think of how we decide the best teams in baseball from the worst teams in baseball, it's 1 game in 5. So let's imagine we have all these games and all these teams are all playing each other. We're basically saying, let's look at this season in chunks of 5 games. Okay? The best teams are going to win 2 games. The worst teams are going to win 2 games. How we determine the best from the worst is just that last game. Right? That's 1 game in 5. Okay? It's 1 game in 5. So, the rub is, not only do we start with low information on baseball teams early in the year, we can't take a lot of really good information from the results that happen early in the year. Right? Like that, if you go back and you look at the wagering, like early in the year, let's say for Pittsburgh, especially for Tampa Bay, because Tampa Bay is actually my case, so I've looked at this, right? You look early in the year, it turns out Tampa Bay was an awesome team that year. They were good, all this talent for being crappy for so long. They had like all these amazing draft picks, right? They were really, really good that year, but there's all this idea that they're Tampa Bay, they're just bad, so they're just, we're not, the wagering market's not going to be able to understand or figure out they're going to be good early. So you look early in the year and you see Tampa Bay being like staggering underdogs to just middling team like Cleveland, right? Just like the staggering underdog. And then Tampa Bay wins and the next game's the same because you don't know whether Tampa Bay is winning that game because they're good or just because we're playing the baseball game. There's just a lot of variation in what's going on. So we see it's, and so the question, people like says, well, why April? Well, it's not like we don't know Tampa Bay's good until the playoffs start. We kind of figure it out after a while, but it takes some time. And if you go back and look, it's those first 2 weeks that's when it's really, really profitable. When we can't figure it out, right? Because even the worst teams will run off these good stretches of baseball. Okay? It took a while for people to figure out, is Tampa Bay actually good? Or are they just having a good stretch as a bad team? You just don't know. Right? There's a lot of uncertainty in what's going on here. So if we take that and we combine it with the fact that we've got this variable return betting market. We don't bet point spreads in baseball. People don't do that. Okay? In hockey, you also have money line wagering. Up until about, when was it, 2000, maybe 1990s, I think it was. You actually used to have point spread betting in hockey. That market kind of fell apart. Now they do money line wagering there as well. But we've got these variable return wagering, and we've got all this uncertainty that persists for a little while with these variable returns. The best way I can examine it is this. Let's say that I offer you a wager on a coin flip. Okay? I take a coin and I flip the coin, or excuse me, I say, you're going to pay me $1. Okay? And we're going to play this game. So you fork over your dollar and say, all right. If it lands on heads, you can call either side you want. But if it lands on heads, I'll pay you $2. Okay? If it lands on tail, and get your initial $1 back, so you get a $3 return. That's a $3 payment instead. Okay? But if it lands on tails, I'll pay you 50 cents. Which one would you take? Take the $2 one, right? Not because you think it's going to be heads, right? You don't know what it's going to be. You do it because that's the smart wager. Well, let's go back and let's realize, remember, let me scoot back here. When we're looking, and you notice that the strategy is always to bet on underdogs. Well, what's the, I mean, I'm kind of making, it's analogous that these early season games in baseball are kind of like a coin flip. Right? So when we don't know what's going on, what's the right one to bet on? Well, it's the one that's going to pay you more than 1-to-1. That's the one where your money makes sense. Not because I think they're going to win, just because it's a coin flip. We don't know at this point. The market hasn't established. The information's not there. Right? But that's just the one that pays out better. That's the best way I can describe that in terms of what's going on. Okay? It's just use that uncertainty to your advantage. And that's what the market's bearing out. Okay? Any questions on that? Where are we? So we're kind of at a break point.
Gotcha.
Any questions? Yeah.
Have you did April and then you did, early season. Have you considered seeing if there's a break point at April, like tax day?
Tax day. I mean, that's where I put it just to have it be halfway through the month. I don't know how statistically I would pull it out. I mean, because tax day is always going to fall right at that early April line. I'm not, to answer your question.
Like 1 week before, 1 week after, the informational differences shouldn't be that big, but it might have something to do with
Tax day.
whether you're expecting money or not.
Assuming everyone does the return on tax. That's interesting. I'm not concerned with that. Thank you. I will look into that. Thanks. Yeah.
So, are there people that make, are there good examples of people that are making systematic money off of this kind of strategy or employing this type of strategy?
That's kind of the big question here is, who's actually behind this? Are there reasons to believe, and kind of what I want to get into here next, and this may kind of, I'll tell you what, when we talk about this, if that answers your question, good, and if not, then bring it back up kind of in a different way. So my question then, so obviously my paper went from 1999 to 2009. The paper itself was published in January of 2012. So now we've had a couple of years. We've had basically the 2012 season and the 2013 season. I don't have the 2014 data quite yet. But my question was, all right, this paper goes out there. It gets a little bit of press, certainly amongst the people that are interested in things like this, a lot of discussion about it. We'd like to think that wagering markets, are going to respond to these persistently profitable opportunities, right? We'd like to think that the markets can adjust. Maybe it was this, big fat 28% dollar bill on the ground to be going picked up, right? Did someone go and pick that up? Maybe like you're saying, did someone go in there and incorporate this and maybe the market evened out? So it's interesting to me to kind of see what actually happened after the fact. Is it still there? Okay. So what I want to look at then was, I kind of went through this. So just really rudimentary. There's another paper in here to kind of discuss all of this. I just run the numbers. There's really nothing written up on it, right? But before, these were our results for all underdog wagers, just for the heavies, overall for April and early April. It's 90 degrees the way it was before. But our returns here, 3.07, 7.06, right? -1% in that situation. 28 was the big one as well, right? We see a staggering market correction in the last couple of years. Big market correction. That's even like what's the adjective to capture that accurately? That's huge, right? Look at what happened to the heavy underdogs. Look at that. Did I kill the goose that lays the golden egg? Is that what I did? Right? This is the things we do for tenure, right? But this is amazing to see this, right? And again, it's another one of those situations where, as surprising as these numbers were to me the first time I did it, this was surprising too. Go back, run the numbers again, make certain that you did it right. This is right, okay? It's staggering to see what's going on, which is interesting, yeah.
I'm curious. You did this. How much confidence did you have in your results? In other words, are you wealthy now? I mean, if you really believed your results, you'd have mortgaged your home, right? You'd have sold your firstborn, and with an option to buy him back or her back, and then you'd have, bet all these big underdogs at the beginning of the season.
So you're not the first or 50th person to ask me that, actually. I guess the best way to describe that is, there's kind of two things going on to it here, right? There's kind of, on the one side, you've got this betting strategy, but on the other, you still have money on the line, right? And so there's definitely a degree of risk aversion that has to come into this as well. And I mean, despite studying things like this, probably one of the most risk averse people that I know. Another funny thing.
Well, that was why I was talking about the option to buy back.
We also do, I work with a couple other individuals and do research. I'm more interested in kind of the sports stuff in this end. They do a lot of work, and I join in on doing work on horse racing market as well. I mean, there are strategies that definitely go out there and allow you to, in the long run, what I like to call scoop the nickels. There aren't these large, persistent, profitable opportunities out there, but there are some that seem to stick around for a while if you're willing to go after them, you know, and in aggregate after a while you can do it. You know, it's funny we have these conference calls where we talk about these things, and, you know, of the people that know about wagering markets, I mean, we'd like to think that we're, you know, amongst the people that know as much as, you know, a lot of people about these things, certainly around professional bettors, but I mean, we study this stuff, it's interesting to see what's going on. I've bet on like 3 horse races in my life, you know, despite the fact of, I think I lost all 3 of them too, so maybe it's discouraging. There's 2 aspects. There's the knowledge, but there's also the risk aversion that I think you got to factor in there as well. But if we continue to look at this, if we look at what's going on here, 3 possible explanations I think exist at this point, and certainly if you guys have comments, I would love to interact with you guys on what you think might be going on here. At this point, I've got 3 theories as to what may be happening here. First off, should be known, again, I'm not making any claims here on statistical significance of what's going on, I'm just kind of reporting the return as it is. To be clear, this is 11 years of returns, this is 2. To be honest, I mean, you know, 2 years is not a whole lot. It's a fair amount of games, don't get me wrong. It's not like we have 1 game that we're betting on here other than or lose. Right? But nonetheless, we're talking about 2 years versus 11. That's something that I think needs to be kept in mind. When I grabbed 2014, I guess that's a 50% increase in my opinion. So grab 2014, add it in there, just kind of see how this persists over the next couple of years. That's something fun to look at. Maybe it's the case, though, that win percentages of underdogs were just happening to be abnormally high in that original data, or abnormally low in the new data. Maybe it's the case that this still persists, and this is kind of a function of what's going on here. Maybe this is the case that this is the true nature of the world, and this is still persisting. We've just found a case where in the last couple of years, turns out underdogs, you know, these games are stochastic. There's some chance to them. That's why sports are exciting, right? There's some uncertainty in the outcome. Maybe it's just the case that underdogs, for whatever reason, maybe they're not winning as much. Maybe it's the case that the schedule is such that maybe we all have teams that are, you know, all kind of at the same level playing each other. There aren't like really big underdogs and really big. Could be, right? Basically, there's some chance aspect here that we need to make certain that we're looking at. But also, this is where I'm kind of like patting myself on the back. Maybe it's the case where I went out there and we showed this persistent profitable wagering opportunity, and the market did correct. In fact, maybe in this situation, it overcorrected quite a bit. So those are some possible explanations.
For that third one, do you know if the number of people betting on underdog wages is increased or not? Because if there's this profit opportunity, then we expect more buyers to go to the market. So do you see that?
What I can do, and what I'm going to show you next, is I can't witness exactly how many people are wagering on those markets. I can infer that more people are wagering if the lines change, because more money's coming on one side instead of moving as a result of that. So basically what I said was, let's say that the wagering market, on the hypothesis, let's say the wagering market is adjusting due to this profitable wagering opportunity. This is what was here before. Let's do this, okay? Let's keep the early sample win percentage of underdogs. That's a very rough, this is a very back of the envelope calculation. I'll be the first to admit that, okay? You basically do this adjusted win percentage based on how much of an underdog you are. Basically, let's take the same characteristics of winning by underdogs in the first sample, and then let's transfer that to the second sample, but only let the lines change. To get a sense for how much the line changing is actually responsible for that overall kind of change that we see. So basically it's saying, at most, how much impact am I having on this market? At most, this is not a low value, this is a high value. Okay? At most, I can see maybe a quarter at best. Okay? So maybe it is the case, all right, that we have a situation where we just have a lot more underdogs, maybe winning or losing. Okay? Maybe it's the case, you know, that the market's moving, but I don't think I can go out there and say, look, I'm the reason why these things have changed so much. It wouldn't seem to make a lot of sense, right? I mean, if you see positive and negative, It seems to make a lot of sense at face value. If this study's having a lot of impact, you would think this might go down close to zero. You wouldn't think it would go past zero. It wouldn't seem to make a lot of sense in that situation. It did.
Have you looked at 2-year periods, each 2-year period from 99 to 2009 to see if there was as big of a shift or variable?
I do have that. I mean, I've actually got, I believe every year I've got a little rundown. The 2 years in 2012 and 2013 together, like I think one of these was like -3, one was like -7, something like that, if I remember correctly. Just the 2 most recent years were the 2 smallest single individual years along as well. And if I am not mistaken, there may have been 1 year negative here, and I don't think there were any negative years on either of those. I said it too. I've got a little chart like kind of done out. So yes, obviously there's some variability. There's going to be some variability, but just from like a snapshot and seeing the returns year by year, it's pretty remarkable to kind of look at that. And actually another thing I saw that I thought was interesting was this paper I think was accepted at the end of like 2010. So you've got like this buffer of like 2010, 2011 in terms of, well, but out there people know about it or anything like that. 2010, 2011 were kind of in between. Think of it. So I mean, the question, anytime you're doing something like this, it's like doing time series econometrics, right? If you want to think of that, you know, you're only having like one run through this life, right? Like we're only going from 1999 to 2013 once, okay? Maybe it was the case that Obama got elected, so people don't bet underdogs. I don't know, something stupid, right? I mean, there could always be something coincident to it that could be having an impact on that. And that's always a question, right? And that's always where the background comes in and the research, not the statistics, but the reading comes in. And knowing your subject just all the way around to be able to figure out what's going on. So that's always a possibility.
I'm just wondering, did you do any research on over-unders?
I have not personally looked at over-under markets. Over-under markets are probably going to be most common in football and basketball. I've got data on over-under markets. There are over-under markets in baseball as well. I think they're most robust in basketball and in football. I personally have done research on that stuff.
Have you looked into how teams drop off after the All-Star break? Sometimes there's huge profitable games, like for example the A's, they were leading baseball this past season, and then it completely dropped off.
Sure. As an A's fan, I appreciate you telling me that. Well, let me tell you how I got into this topic actually. So I had there was a friend of mine I was talking to. I've just been friends with years and years and years, and we like sports and looking at wagering stuff and all of this. And to me, just at face value, so if you go back to that statistic, even the best teams win 60% of the time, and the worst teams win about 40% of the time. Sometimes you see these lines that when you go back to the money line, and sometimes you see one that's going to be like -220 and +200. And that's a big number for me, because that means you're getting 2 to 1 on top of your money. 2 to 1 in a situation where even the worst teams win 40% of the time. You don't need a lot of statistics to know, but that's seeming to point you towards money that you can make, right? Now that's assuming that even with, granted, when we get lines like this, that's when the very best teams are playing the very worst teams, or the very best pitchers are throwing against the very worst pitchers, things like that. Okay? That's perhaps a bit much to say that the 60-40 holds, and in fact it doesn't. You know, in those particular situations, it's going to be even less. But I said, let's just follow it for a year. Just make a hypothetical bet. Every time there's a +200 day, I'll take it, and let's see if it ends up being profitable. Okay? So I just tracked it. I just would check the lines every morning, and I just hypothetically place a 1-unit bet every time there'd be a +200 line, and off we go. Let's just see what happens. And what happened was, so we start the season. And my 200 bets, I'm killing it to start with. And then I come back down here, and then by the end of the season I was about here, which, by the way, more evidence of the market being staggeringly strong, right? No simple, persistent wagering option should sit there for a long time. I picked a simple option, just bet on 200s, let's see what happens. Doesn't end up being profitable. Well, if you guys know this presentation, guess what this point is? You guys know where that might be? The end of April. Yeah, exactly. It'll be the end of April. And so the season went on, went down here, went down here. Any baseball fans here know what this might have been? About 5 or 6 no, close. You're a month away. It's on September 1st. Rosters expand, right? When rosters expand, they go from 25 to 40. Teams that are out of it pick up players from the minors and kind of throw them in there as kind of a trial by fire to see who's really kind of plan for the next year, right? What does that do to our information of the team? Is that an increase in information, or do you think uncertainty is increased when we're playing a bunch of minor leaguers that have never played before? Uncertainty goes up. Absolutely it does, right? And go back to the idea. When uncertainty goes up, go back to the coin flip game, right? Just go to who's paying you more because we don't know what's going on here, right? So I was really thinking this would be the other end of the theory that I had. So when I did the paper, I actually tested this, not only for April, but for September as well, right? Didn't end up bearing out. This was just kind of a unique situation, which to your point of like year by year, right? If I did this year by year, it wouldn't always look like this. It was actually just, I guess, by chance that I was fortunate that it did this, because this really kind of solidified my thinking and theory of how these things kind of end up working, right? But no, I really thought, that'd be a situation where there might be a lot more uncertainty. And I think, in the past there may have been. The way baseball's structured now, rookies have these clocks that general managers are always cognizant of. They don't want to bring them up for no reason because they want their arbitration to be pushed out longer. Even more of the high money team, the Dodgers, the Yankees, the Red Sox, those teams like that, are cognizant of when bringing up rookies. So I feel like maybe if we looked even further to the past, maybe even at the early part of this, and then even before 1999, I feel like there might be something to that theory. But even then, it's only established teams, not established teams that we've established as being probably not as strong, or they are not as strong as the rest of baseball. Is the uncertainty as great as it is in the beginning of the season? If we have good teams that have their players that they don't change, that they play the same players all year, even in September, playing bad teams that have replaced their bad players with players we just don't know anything about. Yeah, it's uncertain, but it's not uncertain to the point where the Astros have lost 100 games by September 1st, and they brought up a bunch of minor leaguers who were evidently not good enough to play on the 100-loss team, and now they're going to win like 25 games. It's a bit of a push in that situation. But there was some uncertainty, and I was thinking that might have been something. It's the process of research. Sometimes it's not. Yeah.
Have you looked at previous decades to see if maybe those profits smooth out over time?
If you can find that data for me, I would love to be able to look at that. But that's just kind of the data that we have right now. Data on wagering stuff is tough to find. If you're good at computer science, you can kind of troll the internet and grab it that way. That's where this data came from. And a big part of that is establishing that that's legitimate data, and it is legitimate data. We've done a lot of work to show that those mirror very well what's going on in kind of the brick and mortar sports books, if you will. Coverage.com is a place that has a lot of lines. You can go online, 5 Dimes has them too. There's different contests you can do and stuff like that. But their lines, I mean, it's also a big part of the paper. The first half of that paper is establishing that this data is legit, and it's actually, if anything, to be honest, and I think this upset people, if anything, these online markets appear to be a little bit more efficient than actually the brick and mortar ones, believe it or not, because I think they're willing to let lines move. When we see things like this in casinos, usually they go by increments of 5. So you'll see like a plus 140, 145, 150. You won't tend to see like plus 152, but you will see it online. Okay? And then actually by letting them do that individual number just by a unit as opposed to by 5 units actually pushes them closer to efficiency, which is another interesting idea kind of itself. Is there another hand? Yes.
I'm curious, you were talking about the end of the season. Did you try, or did you look at subsamples and say games involving teams still in contention, games involving teams neither one of which is in contention, and games involving, one of each?
Right. I mean, it's as a way of trying to gauge the uncertainty, basically, as a way of trying to piece out what the uncertainty could be. I did not, though. I absolutely did not. It sounds like a good thing for my GA deal. Yeah.
Matt, I think I have a really obvious question. I'm sure someone asked you before. In your data set, you had this, what about the money ball effect? Because Oakland Athletics, I assume they were underdog, right? Heavy underdog.
I mean,
So basically 2 questions. First one, do you see any of the effect? If you see effect of your study on wagering markets, can you see the effect of the money ball I mean, the book was published in 2002, 2003.
Yeah, I think the book, well, the A's season that it followed was 2002. I know the book came out not too long after, so let's say 2003 is probably a fair estimate of what's
So
going on.
do you see can you see the effect of the book on wagering markets? And second question,
Sorry.
can you see insider trading in wagering markets when it comes to betting on Oakland Athletics? How did markets bet on that in 2002?
In terms of the wagering markets with regards to around 2003, again, when we went back to looking at every individual year, this is pretty representative. We're not really, being perfectly honest with you, not misrepresenting any sort of staggering amount of variation by taking just one average here. I mean, these years, there's a fair amount of variation here, only because, you know, if you saw there's like 146 bets I think that you could make right here. I think there were like 146 bets you can make. Divide that by 10, it's only like 15 a year. So there's a lot of variation here. But these numbers here, I mean, they're pretty constant over the years. I'm not trying to hide too much variation. So I don't necessarily think there was a whole lot of money ball, only because it would have been like right in the middle of that data set. Let's say 04 is when it starts showing up, right? And that's still half the data. So I didn't see a whole lot difference there. In terms of insider trading, if I can understand the gist of your question, a lot of people, do you guys are familiar with Moneyball? Well, actually, it was made like a major movie. So this idea that Billy Beane, the GM of the A's, went out, and since they were a low market team, they had to go and try and find like market inefficiencies to try and win the game. Basically, they use statistics very heavy, you know, trying to assemble teams, not by like traditional scouting, but by statistics and finding market inefficiencies. It's a story of market inefficiency, is what it is. A lot of people said, at face value, they said, you know, the A's had been successful in 2002. They had been close to making the playoffs in '99. They made it in 2000, 2001, and 2002. Okay? Actually, over that time span, I think they won more games than the Yankees did. Okay? So they were good, not just like barely making the playoffs. They were good. And people were like, well, then why let Michael Loomis follow you around and write a book? Right? Isn't he kind of showing your secret of what's going on here? And the gist was like, baseball was catching up at that point. It wasn't like he was revealing this big secret. He was revealing this big secret to us, right? But it wasn't like those in baseball were kind of starting to figure it out and go along the way fast. So it came out in 2003. In 2004, the Red Sox won the World Series. And a lot of people kind of attribute that as the first kind of sabermetric World Series that someone won by virtue of the new stuff. So in terms of insider trading on that particular Moneyball knowledge, I don't think, I guess it's how we define insider trading. I guess
No, it would be interesting to see in your data set how people bet on Oakland Athletics in 2002.
Oh, like Oakland in particular?
Yeah,
Ah.
it's interesting to see.
Yeah,
And
that-
this
no, that's
bets are
definitely-
different from.
I didn't look at that. Again, the goal with this, when we look at wagering markets, is we don't, it's tempting to want and go and find a very unique, nuanced wagering strategy that's going to be profitable. You have to like really want to fight against that though. Like the easier the better for showing this. Like what is easier than just saying, find every team with a +5 bet amount. It's about as easy as it's going to get kind of in that situation. So we want to kind of move away, but maybe Oakland, yeah, that's something that might be interesting to look at. I mean, even in it, we obviously we have all the teams when we look at each individual team, but just trying to get a broad overview, but no, I think it's better. Yeah.
Yeah, can this be affected by like the, I guess, news store parity ability, like the luxury tax, shot slot rules? Kind of like where like teams are like, I guess it's not being caught in models or teams are there's a lot more uncertainty, but nothing more.
Yeah, I mean, again, so it's kind of a story of uncertainty, it's a story of information. So anything that starts playing with the uncertainty or the information is something worth investigating. For example, I've got a student writing a senior thesis right now that's using this theory, but looking at basketball wagering. Right? So he's saying, came in my office and he said, so I'm trying to figure out where there could be some uncertainty, or there could be some of these information effects that are kind of, you know, where information is higher in some areas or higher in low areas. So he's looking at money line wagering across different levels of basketball. So he's looking at the NBA, he's looking at major college basketball, but then he's got data all the way down to like mid-college, or like mid-Division I, low Division I. Duquesne would be like an example of like mid-Division I playing the Atlantic 10, major Division I would be like the SEC and the ACC and stuff like that. He's even got all those low Division I games, right? Like the only time you see him play is in like March when they're like getting ready to go to the NCAA tournament, right? Like all the small schools there. And so looking at, do we have these information discrepancies across these games, such that is it to the point where we go back to the coin flip example, right? If you know, small school from the middle of Mississippi plays small school from the middle of Alabama, two really, really small schools that people may not necessarily know a lot about, is the information necessarily short enough that it then makes sense to just bet underdogs unilaterally, right? Because that's what the theory says. If information's short, right, go to the money line, go to that variable return wagering market, right, and pick the stuff that's going to give you more of a return. That's what it says. And actually, it's preliminary results seem to imply. It's not as big as this. They seem to imply there might be something there. And in fact, when you combine that, right, with the fact that, you know, throughout the season we learned, okay, you take those low information games early in the year, right, there may be some reason to believe that we see those information effects, maybe even in the college basketball market too. NBA is very, very efficient. Okay, all those pro markets are very efficient. There might be some inefficiencies in the college level. Yeah.
Why do betting markets give out such high underdog ratings, given how little information there is? I mean, I can see like past biases in baseball might make it where you rate teams coming up this year, but if it is so systematic, as the case seems to be, that these information asymmetries exist, why are betting markets giving such huge payout portions, like paying 160 for 100 units or something?
Right. I mean, it could be the case. First off, people maybe just aren't aware of this. Okay, so that could be something as well. But you know, we may also see this too. We tested for this. It wasn't really very strong. I didn't like where it was going with the paper. But you know, maybe we've got people from big markets that are just really amped up that the season's starting. They're betting their team regardless. Oh, the Yankees are playing the Rays. I bet the Yankees because the Yankees are always awesome and the Rays always suck. And again, it's not the goal of the casino, to be honest. And this is actually kind of an urgent area that's coming through Asian markets too, and it's been out for a little while, but it's not the goal of the casino to try and find the right price, right? It's the goal of the casino to balance the money on both sides. So if we get a big chunk on one side, we need to maybe move it over enough to get enough people to bet on the other side. There's no guarantee that's right where it is. Right? We have people betting for a lot of reasons. I mean, that's a big thing when it comes to looking at bias research as well, is why do we see these persistent biases? One of them, people like to think, is we have like experienced bettors versus inexperienced bettors, or like professional bettors versus casual bettors, right? So if we look at the horse racing market, the best way to describe this, you've got some serious people. They got the catalog. They've seen all the races these horses have been in. They've got a lot of information. They're making educated bets on who they think's going to win. But guess who else is getting involved in that market? Maybe I take my daughter down there and she's like, I like the pink one, so let's go put some money on that, right? Making decisions for just whatever reason. Right? So if we have these casual bettors, that that might distort things enough that we see this persistent like bias that's in the market as well. We'd like to think, like when we start with these markets, we think, everybody's informed, and it's people that are the smarts are betting against the smarts, and everyone's like trying to get that information advantage way on like the 99th percentile of knowledge, right? That's not everybody, right? I mean, think of random wagers you've made with your friends. It doesn't have to be sports. Right? Like, what's that Seinfeld episode where they're like betting on the planes coming into the airport? Someone here watch Seinfeld? I just date myself too much. Bet on a lot of things, right? But it's like, no one's ever, I'll bet you my bus shows up before your bus at the bus station. Whatever, right? I mean, what do you like there? Like studying the history of the buses. Do you know what the traffic report is? The weather? I mean, we're not always super informed. We make bets, and there's enough people that aren't super informed. They can push things around a little bit differently. And that's a big theory that people believe is causing this persistent bias in some of these markets. Yeah.
You mentioned people getting excited at the beginning of the season. I actually would have thought this would have had the opposite effect. At the beginning of the season, everyone is optimistic. This is the year, and so they would bet on their favorite team, underdogs. I mean, people are already betting on the Yankees, but no one's betting on the underdogs. Except in the beginning of the season, everyone's optimistic, and so I would have thought that with all this money going into the underdogs, the payout to underdogs would have been squashed too low in the opposite direction. So your results are actually much stronger than like a psychologist would have predicted just on the face of optimism.
And the way I tried to capture the heterogeneity of that is, and this is like, I mean, if this is even a decent proxy, I don't even know, but the population of New York's a lot bigger than Kansas City. Ergo, there's a lot more people getting more popular about the Yankees than the Royals. Yeah. I mean, that's one way to try and get after it. Try to throw some population stuff in there and do that. I mean, I was really looking for a lot of things when doing this research, trying to figure out the best ways that, how can you really describe what's going on? Like, the more I was looking at these different possibilities, the more I was like, let's lean on the economics of it. I think the economics give us a decent explanation as to what's going on.
Okay, we'll take the last question.
I'm just wondering, it seems to me you're talking about at the beginning of the season, you have less information, and that's why this seems to work. You know, I get to wondering if this research would spill over into futures markets. You know, at the beginning of when a corn contract first comes on, people really don't know what the corn crop's gonna look like for that year. They have expectations and all. I'm wondering if your research would be, could, you know, migrate over into that area.
There's a paper that I would love to do, it's an issue of getting the data, but basically what you're kind of describing is when we have low information situations, people, they herd, basically, there's like herding. So they try and look at prices and they kind of move over to that, if I could tell the story in like a minute, and then you guys get out of here. There's a guy named Colin Kammerer, he's an economist at Caltech, and he wanted to test herding in these markets. He wanted to test herding in financial markets, but that's really hard to test, so he went over to wagering markets and did it instead. Here's what he did. He went down to Del Mar, it's a really famous racetrack in Southern California. This paper's in the Journal of Political Economy. It's like my favorite wagering market paper ever. Goes down to Del Mar racetrack, and like I told you about pari-mutuel markets, those odds when you go, if you've ever been to a racetrack or a dog track, are determined by how much money's in the market. Okay, so you'll sit there and you'll see posted odds, and then people will bet and the odds will change, right? And so the idea, if there's herding, is people will see betting after the odds change because people are getting information from the previous bets. Well, he went down there, and he like, you know, most people when you go to horse tracks, you'll make like a $2 bet or you make like a bunch of $2 bets, right? He went down there, and let's assume that there's like $3,000 in the pool. He bet like $10,000 in the pool, right? And imagine what that does to the odds, right? All of a sudden you're seeing odds like moving a little bit. All of a sudden one horse is like a 1 to 100 favorite, and then all the rest are like 99 to 1. Now imagine that, you're sitting there and you're like, oh my God, right? So he goes down there and he just takes this lump of money and like slaps it on there like 5 minutes before post. Let's say 5 minutes before the game. So everyone's like running up there and he's like charting what's going on. And then to like the coup de grace was with a minute left, he canceled his bet. So then it like shocked it again. And everybody watched it out, and people like ran around. Del Mar was not too, this was in like the 80s that he did this, and Del Mar eventually, I believe Del Mar kind of found out what he was doing. He was only able to do it like 40 or 50 times. There was no herding, but they kicked him out. They actually don't let him back there. He's doing something like that. But there ended up being no herding. But I think there's actually better ways to do that. There's more natural experiments, so there could be some herding. Absolutely, these things, you know, are attributed to financial markets. Undoubtedly, they are. Absolutely, they are.
Guys, next time we'll